if we sell $1 million of Stretch and we buy $1 million of Bitcoin and Bitcoin appreciates 30% a year, then we've got a big capital gain in the Bitcoin. You want to monetize that in a tax-efficient way. There are two ways to do it that are pretty obvious. One way would be to sell the Bitcoin as long as the tax basis is higher than the sale price. So if you can sell high basis Bitcoin, then you can actually generate a cash stream to pay the dividend just with the Bitcoin itself. The easier way.
Saylor begins by reflecting on what didn't work in legacy financial systems. He criticizes several structures, over-the-counter, OTC instruments, especially Rule 144A securities, which exclude retail investors and limit access, fixed maturity debt, which introduces credit risk and refinancing uncertainty, niche bond markets, which lack liquidity and broad capital participation. In short, traditional finance is fragmented, restrictive, and inefficient. It often locks out global investors and introduces unnecessary risk through rigid timelines and limited distribution channels. What did work, however, were publicly tradable securities like NASDAQ-listed equities, shelf registrations, allowing continuous issuance, mechanisms that amplify capital beyond simple equity issuance. This mix of successes and failures led Saylor toward a new idea: build a financial instrument that keeps the advantages but eliminates the weaknesses.
Yeah, I think Stretch is an amalgam of all of the good things that we discovered on our way to the revolution and our attempt to run away from all the bad things. So what worked really well? 4-letter tickers that are available from broker-dealers on NASDAQ worked well. At the market shelf registrations, we thought that was a magic tool. Amplification via something other than just straight equity, we thought that was good. What we didn't like is over-the-counter 144A issues, because the entire retail market and public investors were locked out, so that was bad. We didn't like debt that came due with a certain date, because it created a huge amount of credit risk and uncertainties. So that's bad. We didn't like the fact that we were trapped in a small set of niche corporate bond markets without a lot of flow of capital. That was bad. And so eventually we discovered preferred stock, so we could sell a security to the general public everywhere in the world that was perpetual, so you could attach a shelf registration to it that anybody could buy. And so STRC represented a walk, down that stack to preferred. And then in the preferred world, it represented the shortest duration, least delta, most stable, least volatile security. And so I would say it represents the highest amount of financial engineering we've done, but the result of that was the simplest product we'd ever created. It's just like when the iPhone didn't have a keyboard. It's like fewer moving parts. So by the time the dust settles, Stretch just becomes a Bitcoin-backed high-yield bank account that pays you double digits. And the last part, just serendipitous, was that we found that if you sell a credit instrument and then you make a capital investment forever, and then you hold the capital forever, then the dividends that we pay on the credit instrument become a return of capital. So we created the most tax-efficient perpetual instrument because of the total simplicity of the idea, which is make a capital investment forever, strip the volatility and the risk off of it, and convert the capital gain into a defined dividend stream that's tax deferred. And I guess we had to do everything else to get there. The goal is just to acquire as much Bitcoin as possible. We're just trying to make as much money as possible. It's not a complicated goal. Bitcoin is money. We want to acquire the Bitcoin. We expect Bitcoin to go up forever. it turns out that if you want to pay a tax-deferred dividend, then you need to monetize an unrealized capital gain. And so if we sell $1 million of Stretch and we buy $1 million of Bitcoin and Bitcoin appreciates 30% a year, then we've got a big capital gain in the Bitcoin. You want to monetize that in a tax-efficient way. There are two ways to do it that are pretty obvious. One way would be to sell the Bitcoin as long as the tax basis is higher than the sale price. So if you can sell high basis Bitcoin, then you can actually generate a cash stream to pay the dividend just with the Bitcoin itself. The easier way is you sell a derivative of the Bitcoin, a derivative of the capital asset. And it happens that we have a derivative, and the derivative is MSTR, the common equity. So when we're selling the common equity, we're selling a derivative to generate tax-deferred income that we can pay back to the credit investors. And when we're selling the equity at a premium to the underlying NAV, then it turns out to be accretive to the common stock and a benefit to the credit investor. So what we generally do is we use the equity ATM in order to generate the cash stream to pay the credit investors. Most of the amplification for the equity comes from the credit. If you sell $1 million of credit, then you've got $1 million of Bitcoin and you didn't actually dilute the shares at all. Over the course of the next year, you'll issue 10 or 11%, but what you're doing really is you're generating massive upfront amplification. Another way to amplify is you just sell equity at a premium to NAV. If you sell $1 million of equity at MNAV of 2, then you've created $500,000 of BTC gains. That's also amplification. We've done that. In the future, we may do more of that. We do it occasionally. We did it last week. We sold $255 million worth of equity at a premium. We generated a Bitcoin gain and some amplification on that. And we expanded our capital base to support the credit issuance. But for the most part, if we sell $10 billion of STRC, we'll generate a $10 billion gain on that up front. So most of the BTC gain and the yield comes from the credit, not from the equity right now.
Here's where the innovation becomes more profound. Bitcoin is inherently volatile. That volatility creates massive unrealized capital gains, but also uncertainty. Saylor's strategy is to hold Bitcoin indefinitely, extract value from its appreciation, convert that value into stable, predictable income. This is done through two main mechanisms. A, monetizing unrealized gains. Instead of selling Bitcoin outright, which triggers taxes, Saylor explores ways to generate income from it indirectly. One approach, sell Bitcoin selectively when tax efficient, e.g. high cost basis. Another, more scalable approach, sell derivatives of the Bitcoin position, specifically MicroStrategy's own equity, MSTR. B, using equity as a financial engine. MicroStrategy stock acts as a leveraged proxy for Bitcoin. When the company sells shares at a premium to its net asset value, NA, it effectively raises capital, generates additional Bitcoin exposure, creates value for both equity holders and credit investors. This mechanism allows Saylor to fund dividends without directly liquidating Bitcoin, maintaining long-term exposure while still producing cash flow.
Yeah, well, what we realized is the three-layer stack is going to be digital capital, like a 30 to 40 ARR, 30 to 40 vol commodity. Digital credit, about a 2 vol, 10, 11% yielding instrument. And then the third layer is digital money or digital yield. And digital money would be a 0 vol, a pure money market type instrument that pays something better than normal money market. So maybe 0 vol, 8%, or in that range. So one compelling thing you can do with credit is create digital money. And you can create digital money in the form of an ETF or or an ETP, or you can create it as a token, or you can create it as an account. So I think important integrations are integrating Stretch into public ETFs in order to create that sort of instrument. I think integrating it into crypto exchanges. At some point, some crypto exchange will just offer you a digital yield account or digital money account that pays 8%. You just put your money on the exchange, they pay you 8% for your money on deposit. And then I think the third is the emerging class of savings coins. There's a $350 billion stablecoin market. A lot of them want to generate yield on the stable coin. So the way that works is you buy the stable coin, you stake the stable coin, you get back a savings coin or a yield-bearing coin. And STRC powers the yield on savings coins. In fact, I would say everybody's looking for how do I generate yield on Bitcoin or how do I generate yield on stable coins. And so Stretch or digital credit is like an ideal way to generate that yield on either of those. And you can do it on chain, you can do it via DeFi protocol, and people are working on it with DeFi protocols in the Bitcoin world and the stablecoin world. Or you can do it probably just on a centralized exchange, or you could do it with a bank. Right now, I think I see about a dozen projects that are going on in this area. Maybe 12 to 24, it's exploding. And all of those are different approaches. There's an explosion of entrepreneurial activity right now. And the same is true with crypto exchanges. So I think there's an entrepreneurial battle to see who's going to win the digital money race. And then there's digital yield. And in the digital yield, if the cost of capital is 400 basis points, then why wouldn't you just borrow at 400 basis points and lend at 1,150 basis points and loop it 3 times or 4 times or 5 times? And you're going to see a lot of people in the DeFi ecosystem, and they're going to loop these 8% coins 5 times to get to a 30% yield or a 40% yield. And that'll be interesting. But you can also do it if you're any kind of hedge fund in the US. I can borrow money at SOFR plus 50 basis points. So that's 425 basis points right now. So I think there's a lot of carry trade that will be coming. This entire exercise is going to be about a question of do you create a private fund? You know, a private fund that's like illiquid or 1 month or 3 months of liquidity and go for yield? Do you create a public fund and take it public? Do you take it public in Europe or do you take it public in the US? Do you create a crypto account? Do you create a bank account? Or do you create a token? And if so, in what regime? And then there'll be a bit of battle about, are you going to do this on Ethereum or Solana? Are you going to do it on the CeFi exchange or on Base? And then how many different DeFi protocols will you link it to? So, and I haven't even mentioned the last thing, which is you can also just take STRC and do a currency transform, and you can generate 8% yields in Swiss francs or Japanese yen. So what happens if you decide to start generating 8% or 6% yields in yen, francs, euros, pounds? And those are all interesting opportunities. And all of this is an exercise in one part is financial engineering, like how do you construct the volatility reserves and how do you manage the operation. One part is design. Are you going to offer daily liquidity, daily dividends, 0 vol? Are you going to offer monthly liquidity, 5 vol? You know, there are senior and junior tranches. So part of it is that. Part of it is distribution. Can you get distribution from the Commonwealth Bank of Australia? Can you get distribution from Deutsche Bank? Can you get distribution from Binance? So part of it's that. And then part of it's regulatory approval. Is the container a bank account, an ETF, an ETP, a crypto token, etc.? And that's a lot of work. And I don't even know the right answer, except I rather think we're shipping kerosene or gasoline, and we think there's a world of motor vehicles and service stations and trains and planes and automobiles and things to be built. And we kind of need all of the digital yield, digital money partners to build all of those things. Because probably, if you're a conservative investor in Switzerland, you don't want the same product as a Japanese retiree or as a hedge fund in London. So I think there'll be different products for different investors, but the addressable market is, if it's 10% of the credit market, it's $30 trillion.
Saylor doesn't see this as a niche product. He sees it integrating everywhere: ETFs and ETPs for public market access, crypto exchanges offering yield-bearing accounts, stablecoins and savings coins generating passive income, DeFi protocols enabling leveraged yield strategies, banks and traditional institutions distributing these products globally. He predicts an explosion of innovation, with dozens of competing projects, multiple blockchain ecosystems, Ethereum, Solana, etc. New financial products tailored to different regions and investor types. This becomes a global competition to define digital money and digital yield.